All right. Sounds good. Hey, Paul.
Hey, I'm Paul Vincent.
Adam Vincent here. Welcome. We are attorneys with Vincent Esquire and Brothers for those who don't realize that or know that. And we're going to talk about syndication, raising capital legally, it looks like.
That's right. That's the topic of the day. We've done this a few times. We wanted to include some updates, and hopefully we perform better on this one than we have in all the others.
Thanks for joining us. Let's get right into it. When I figure out how to click the slides. There we go. Yes, I'm Adam. That's Paul. Here's our contact info. We are attorneys in Ohio out of Westlake on the west side of Cleveland and Akron area. And we focus on real estate law. Have a lot of entrepreneurial clients who do real estate and business or both. And we also do some estate planning for those clients and other clients, putting together wills and trusts and things of that nature. And anything else to add about us, Paul?
The right now we're in our office right there. We're in the woods, so
Great.
dynamic drop in.
Nice job, Monty. All right, so this is the plan for the day. We try to break it up into four areas: acquire it, structure it, marketed it, and raise and close it. Um, so we'll go step by step on those. Just following along on a real estate deal, as we'll talk about later. Syndication doesn't is something that can be utilized by anybody buying a business or making a big purchase. But we'll mostly focus on the real estate transaction. The mechanics, the mechanisms, the same sort of thing, whether real estate or not.
And as a reminder, here is your boring lawyer legal disclosure. This is for educational purposes. Don't use this as legal advice. Make sure to consult with an attorney, a qualified one that you like working with. This does not establish an attorney-client relationship only until you pay us big bucks. So
Fee agreements, important.
that's right.
Engagement letters, also known as. Speaking of lawyers, we just want to throw this out there because we have clients who wait till it's too late to find a lawyer. Better to find a lawyer up front, get things in order, avoid future lawsuits and issues by having a lawyer that you can ask questions to before you actually try to do something or to help you put things together for your business. So find someone you're comfortable with. A lot of clients we work with, we kind of see it more as a partnership. So somebody that you can call without thinking two or three times about whether or not to call and whether it's worth it. A lot of times we talk to somebody about the issue they call about, but then it winds up revealing a few other things that are important to take into consideration or other things that might lead to problems. So again, just find a lawyer. They're worth their pay.
Yep. Yeah.
Anything
And
to
like
add,
I
Paul?
mentioned, the partnership, not the legal partnership, but somebody that really wants to help you close that deal. We work with all sorts of different lawyers, and we're with you guys in that some of them are really fun and easy to work with, and others it's like you're torturing them. So find somebody you enjoy working with, somebody that is interested in your success, that will pay off big as especially on any sort of commercial transaction, whether it be real estate or business. There is always a big hairy monster right at the end of the closing, and that person has to be equipped and interested enough to get that thing over the finish line. And they're not all created equal. So
That's
anyway.
right. Yep. So jumping right in, let's talk about the definition of a syndication for those who aren't aware. The basic idea of it is that it's the pooling of resources. So here we have a few ways to think about it. A group of individuals or legal entities, they could be LLCs that are all coming together, or it could just be, three or four friends combining resources for a common goal. That's a syndication. Um, Many times in these deals, real estate or business deals, you put together a new special purpose entity, such as a limited liability company, an LLC, and there is a driver or a operator that's kind of in charge, steering the operation, general partners, active partners, sponsors, and then investors, passive investors become and are referred to as limited partners. They become limited partners or um, members of that LLC. If you're going the LLC route, they become members of the LLC, usually as a separate class that has limited control over the company, unlike the active partners. And so you are pooling investor money together and using generally institutional funding to put together your sources to be put to use for whatever acquisition you're aiming for. A lot of people, worth noting, have performed syndication without either acknowledging it or realizing it. They pool money together. They don't put together the paperwork. They don't necessarily do all the things they should be, and that does happen commonly, not necessarily out of bad faith or as a bad actor, but just people that don't realize it. So that does happen, but we do not recommend it. Paul,
Yep.
why don't you talk about the four elements?
Yep. Before I jump into these really broad elements of what a security is, if you are borrowing money from anybody to do something that you can't afford yourself, you should call a lawyer. He or she will be able to tell you whether or not it's a syndication situation or some other exemption that you don't have to do this sort of paperwork. So if you're borrowing money from somebody, more than likely you don't know what you're doing, and you should pay a pro to make sure everybody's on the same page and in as close to a safe position as they can be when you're using other people's money for stuff like real estate or a business acquisition. It's not always a syndication, but many times it is, and many times people don't do it the right way. So, with that being said, what is a security? So, you're selling a security when somebody gives you something and expects something in return. It's been defined by the Supreme Court very broadly. It's that security is anything that is an investment of value. Many times that's money when you expect a profit on that money, and that money comes through the efforts of somebody else. So Adam gives me money, I use that money and hopefully grow it, and we both make money on the successful outcome of whatever it is where we're pursuing, and that itself is a security. And kind of the one of the more important things is how many people are actually investing in it. Um, Even though there's only one, it's still a security, but many times people don't end up doing the syndication paperwork for one, even though they should. But on the fourth element, it's with more than one investor that are all going after the same pursuit, the pursuit of selling a house, selling a building, improving a business for resale, that sort of thing. So there's a very broad definition. If you're wondering if it's a security, 99 times out of 100, it probably is.
Yep. And just to add for Paul, if you think it might be a security, you should get your paperwork together as the operator. If you're an investor, you should also talk to lawyers about those investment opportunities to be sure you understand the risks fully and you understand how they have it structured. Because the PPM actually is somewhat of a limitation on investors. But other arrangements can have their own problems. You know, notes and mortgages seem like a good idea, but there's some pitfalls there too. So on either side of the transaction, get the right advice before diving right in.
Yep. Yep. If
So,
yeah, and just, stating again, if you are borrowing money from anybody, make sure you talk to a lawyer about it, especially if it's your first time. Like if it's your first time and you're like, oh, I went to this thing this weekend, sat next to a person, they want to put some money in this deal I have. If it's your first time, that's when you, without question, should get it done because the internet is not the greatest source for useful and practical advice for this sort of thing. So,
yep. And so to talk about this, we're just going to take a look at a sample deal here. We just are doing round numbers here, 100 units in any state, United States of America. But usually these value adds are C class. You need some CapEx. So the deal we get under contract in this case by syndicator Saul Adams, LLC. In this case, we want to take a side note. That's a marketing LLC owned by Saul. We mentioned before these deals usually require, especially if a lender's involved, require a new single purpose entity with its single purpose to be investing in the opportunity. The bank wants a clean slate. The bank doesn't want any that LLC to be used for anything else. So they ask you to do that. So who gets under contract? Well, it's either Saul Adams himself or maybe Saul has a marketing LLC. And so that's who gets it under contract. And the purchase price in this case was 2.55 million, imagining $550,000 of improvements in the value add opportunity. And then the lending in this case was 2.417 million. And we're going to have reserves and costs set aside for 130,000. That might be an acquisition fee. That might be legal fees and other things like that. And some portion of reserves. And so in this case, to keep things simple, we're going to say in this scenario, we're raising $1 million. So we're going to run through this example and we'll try to take it through each step of the way through the process of a closing.
Yep.
Paul, why don't you talk about how the same formation can apply?
Yeah, so the math that we're running through here, this is all just a financial mechanism on acquiring something you can't afford yourself. So what we're talking about today, you can just wholly replace a real estate asset with a business acquisition. That's a new exciting thing. Many people like me and Adam are looking at going after across the country when everyone was interested in multifamily and storage and mobile home parks. Many still are. It's just now there's this new class that regular folks that aren't, East Coast private equity are going after. And so these principles apply. The same kind of thinking on what you're selling to an investor, what you're acquiring, fees and things like that. It can apply to on the business acquisition side. So we've never mentioned that in our prior versions of this, but it's important to do because we do syndication paperwork and funds for people on the business side too. So,
Yep. So the framework still applies. It's just
yep,
a different goal with the syndication. With the pooling of resources, you have just a different goal. But again, the operators are raising money. They need to put that deal together and put together the proper paperwork. So that's what we're going to run through here. Here's a sample of the structure on how these go. Oftentimes, we as lawyers try to encourage people to keep things relatively simple or as simple as they can on these syndications. You certainly can make it more complicated and sometimes what feels like convoluted. But in this case, we have that new LLC we mentioned. In this case, we're calling it the Hot 100 LLC. It's going to be buying 100 units. They are hot. And then we're going to look at how you kind of split up that Hot 100 LLC that has 100% ownership of itself, and you split that up among the various parties. So Hot 100 LLC will take title once there's the closing. Um, Syndicator Saul Adams, in this case, we said had on our contract. Syndicator Saul Adams is going to have to assign the contract at closing to Hot 100 LLC, the new LLC entity, the borrower for in the eyes of the lender, whenever you're getting senior debt. And then we're breaking it up. And Paul, why don't you talk a little bit about who gets a slice? Who are some of the folks that get a slice of this complete, beautiful pie?
yeah. We won't see this pie very often, but um, there are active members and then inactive members. The active members are what we've done so well here, highlighting the team members that actually run the day to day or have some active role in the company. So there's a syndicator operator. This is the quarterback that's going to be pretty much handling the deal from start to finish, and then hopefully operating it day to day. You have people on the team that might have construction background. They're going to be the folks that are going to help you flip the property. You're going to have hopefully everybody's local, but in many cases that's not the case. But there's someone that might get interested in the company for being boots on the ground. That's the person that's going to check on the property managers, check on the property with regularity to make sure it is improving like the business plan suggests. Maybe you have a person that's going to raise the capital for the deal. Maybe they have a big network. They have a social media influence that can reach out to people and see if they'd like to be interested in joining the deal. And sometimes one of these members is the loan sponsor, but sometimes that can be its own individual person where their only role in the company, at least from the outset, is to sponsor the loan because they have the assets and the balance sheet, the personal financial statement that allows them to qualify for a big loan, like a couple $1 million. So that's who the active members are. Adam, what are inactive
Yeah.
Class
So
B?
then those active members of the team put the team together, and the LPs, the limited partners, or the investing members are going to become Class B members. And the way it's oftentimes structured, so you have the Class A members, the Class A members of the LLC, Hot 100 LLC. When you bring in the investors, they become Class B members of the LLC, and the operating agreement and the private placement memorandum we'll talk about soon will describe that, and it'll also describe the risks and the business plan, and it will describe what the investing members are due to receive. So that's the important thing is you're going to slice up the company into two classes, Class A and Class B. You certainly can do more, as we note there at the bottom. You can have Class C, D, E if you want to do different investor classes. Um, and based on maybe the size of the person's investment, or if you just decide down the road all the investors going forward are going to get something different, you need to separate them by class, and then in the operating agreement it describes what each class gets. So in this case, to keep it simple, we just have Class A active members and Class B passive investing members. And then we're going to talk a little bit more in detail about what that means. And really, when you start putting this together, as you're getting a deal together, you got to start say to yourself, what's the offer? What am I offering to investors? What is the investment opportunity? Here we have the types of returns for investors that are most common, and those are preferred return and equity. For those who don't know what a preferred return is, it's the return of cash flow that is preferred or comes first. It gets paid after debt, so it gets paid after expenses, debt, insurance, taxes, and so on. But it's before the other distributions to all the members. So we said Class A members are the active members, Class B are the passive members. The preferred return is going to go, if you structure this way, 8 or 10%, for example, of a preferred return is going to go to Class B investing members first, and it's 8 or 10% per year on the amount invested. We'll go over that a little bit more
Yep.
here in a moment, but that's what a preferred return does. Paul, your turn to talk about equity.
Yeah, equity is just what you're selling in ownership of that new single purpose entity or special purpose vehicle or whatever people are calling them for your particular deal. So people are investing capital, they're contributing capital to this new venture, and like Adam mentioned, they're going to expect something in return on that money. So that's going to be the preferred return. They get paid first before any other member in the deal. And then the equity is how much of the company are they going to own for that investment? That can be portions of a percentage. That can be many points, many like a good chunk of the deal. It just depends on how you want to set it up. And then kind of the a third option there is, do you want some sort of hurdle or waterfall or some sort of variation on the combination of these two? Those are, we have a little blurb in there that sometimes there is a benchmark on a return that once you hit that benchmark, the company is performing well. They've paid out distributions to the investors, and then that might switch at a percentage. So that's called a waterfall, a hurdle. Over here on the left, you'll see a greasy, well done pizza. For anybody that's watching this now or later, if you mention the correct restaurant, you will have earned yourself a hat you didn't want. We're happy to mail that to you. But you don't want we don't suggest you have your preferred return and equity splits and waterfalls and benchmarks too confusing because then it's going to be too hard to sell. So go with the old classic line I've stolen from someone. I think it might have been Jenny Smith actually. If it's confusing, you're losing. So just try to keep it simple. Make a simple targeted preferred return, a simple round number for equity that people are buying, so people can understand what it is that they're actually getting a piece of, and don't have to do too much math because if they have to do too much math, they're probably not going to cut you a check.
Yeah, you want to limit the number of speed bumps for investors, and math and confusion and chaos is associated with you as an operator is not a good thing. Math maybe is not so bad, but especially when it's confusion or chaos. And so a lot of times when you get these complicated waterfalls or hurdles or other mechanisms and share size and all those sort of things, sometimes that can work against you. So just a little practical advice there, but let's keep it round and simple. Here's a common way. It's simple, but it works, and is a common split is for general active partners. The sponsor, the teammates we talked about a minute ago, Paul outlined, they get 60% of the pie, and limited partners, the investors get 40%. And then that, of course, when we say that's the equity, that's what's going to show up in the ownership schedule. That's part of the operating agreement. That's where you see that, and that's where it's going to list those investors by name when they join the company. Just to clarify, because we know what it means, but they probably don't. If you recognize the maker of that unusual misshapen pie, it was in the news for a while there, and you can name that maker. Reach out. We're giving our contact at the end, and you can win yourself a prize. And the prize Paul described as an unwanted hat. I mean, not the best sales pitch, but
I
anyway,
don't want to give them
it's a
away. They're
fun
so
little
cherished.
story we like to bring up because we like to show this pie and keep things more interesting than boring, dry webinars. Okay, here we go. We're getting there though. If I don't speed it up, we might be there.
Yep.
Okay,
Yeah, we're
so
good.
sample return in this case, we said we're giving away equity and preferred return. This one we're saying preferred return is 10% per annum per year. Usually that's distributed quarterly, so in this case it was 10%, it'd be two and a half a quarter. And then we're saying because we're raising 40%, we're gonna say they're $100,000 units to raise that $1 million we mentioned. And so 40% to LPs divided by 10 units at 100,000 each gets you 4% per unit. So if you invest $100,000, you get 1 unit of 4%, and you get 10% preferred return on the deal. All right. So this sample preferred return is 10% a year, is two and a half quarterly, meaning $2,500 is due to you per quarter, 2,500 on your $100,000 investment. It is at the manager's sole discretion. Quick note: let's say there's not enough cash flow, you can't pay money you don't have, and you also as a manager might decide we have a little in the account but we need some reserves. So in that case, usually the way it's structured is it says it accrues and it's paid in arrears if payment is missed 1 quarter. The option a lot of people think about is whether or not they're going to have a refi or a capital event where they can return some of that money to investors. And in that scenario, if investors get their money back, then they are no longer getting preferred return, of course, because their capital account has been reduced by that amount. So that's how the sample return would go for preferred returns. Paul, it's your turn to talk a little bit about what the 4% does and how that plays out for investors.
Yeah, so you go through the preferred return. Then let's say there's still enough reserves, there's still some cash flow from the asset. That 4% equity means that that person will get 4% of that whatever's left over. So let's say that there's $100,000 left at the end of the quarter after paying all the preferred return for that quarter, which was 2.5%. And there's you paid off all the debt service. You feel like you have enough. Maybe this happens just at the end of the year. So that 4% of that 100,000 means that, pull up your calculators. That means that you get $4,000 of that 100, or whatever your percentage ownership, pro rata ownership is in that company. So let's say about 2 units. That means you would get 8,000 of that 100. That's what the equity does. Is it just gives you an additional chunk, like the active members in the company, when there is a distribution to make. Same as preferred return. This isn't, many times in many real estate deals, there is no cash flow to make these sort of after distributions, but it can. This can also be the triggering point for a waterfall. So, if you're, let's say in that scenario, in this scenario, you're going to pay 12% at X equity, but then there's going to be some sort of new payout when they get 12% on their money for the year. All sorts of different ways to do it. And as a kind of a chance to point this out, this was the way it was set up for a particular deal. This could be wholly different than what you do for your own deal. We try to, and Adam and I, we closed one in May. We try to be as close to a 50-50 setup on how our structures are. We find and we believe that the money is as important as the work. So we give as much of the equity as we think is fair, 50%, to the investors. And your deal may be totally different though. We have clients that give away 10% of the equity to investors, some that give away 80 and 90%. So it just depends on the deal, and it depends how your numbers work and for it to make sense for everybody.
Yep. And it ultimately comes down to there's no definite answer now because you don't know the deal until you get into the deal and figure out how much it's going to cash flow, when it's going to cash flow. One of the things we didn't mention here, but is if you miss it, it's paid in arrears. But also you might have to tell investors if your underwriting says this isn't going to cash flow enough for preferred return for 6 months, you need to tell them that so that they know what they're investing in. So that's the sort of stuff you have to nailed down, and based on the type of asset, value add versus stabilize, and all those sort of things. All these things are moving. All these different levers impact each other and are affected by the deal. So,
Yeah, and if you've done this more than once, I'm sure your second deal was structured differently than your first. At least some variation. It'd be tough to make it the same always. So
yeah, and ultimately, like we said on this one, we aren't going to try not to confuse people by saying there's a waterfall in this one. Ultimately, the waterfall is a way of making it better for Class A members once you reach a goal, but it still keeps investors interested because it's saying, hey, we only get rewarded after we meet this goal of say 14% in this example. So it's a way of kind of balancing the interests of the investors in the company. Um, all right, so let's move real quick to an organization chart, an org chart for anybody who hasn't closed one. This might be new for a lot of us. It wouldn't be if you've closed and the banks required you to get one of these, but that's why I wanted to mention it. Is a lot of times on deals we're helping close, they request that we have an org chart, and it goes all the way over to warm bodies, to the humans behind entities. So in this case, this is what our Hot 100 LLC looks like. Class A members are owning 60%, we just said. Class B investing members are to be determined, but they're eventually going to hold 40% of the company. And so then it's just split up 40% to SA Holdings LLC. That's the Class A member, managing member. That's operated by Saul Adams as sole member. Ground Boots LLC is run by Barry Boots. That's going to get 10%. And then sponsor Steve is got a Delaware entity, but Steve Yobs lives out in California, and he's got the pocketbook and the experience, as Paul mentioned a moment ago, to sponsor the loan. And again, that's the bank saying, hey, we got to get somebody on here that has experience to run this thing successfully, but also the pocketbooks and the interest to make sure it's successful. Because if Steve Yobs has a lot of assets, he doesn't want this thing to foreclose. So those are the functions generally of a sponsor. And then again, down the bottom, you might have an individual investor, somebody investing in their own name, or they may invest through an LLC, like Investor LLC, owned by Ivan Investor, or they might invest through IRAs or other things like that. Those are the folks that show the titles that show up in that ownership schedule in the operating agreement. All right, so we have a total of 10 units at 100K each getting 4% as we described in the previous ones. Here is just an example. I mentioned before that was a member managed by SA Holdings. This is just so to illustrate the idea of a manager managed org chart. Member managed means is the named member manager is also the member of the company. You could do that as one member managing it, or you could do it as all three. In this case, there's three members. It could be all three all have the authority to do it, to manage the company and sign on behalf and bind the company and all that. Or the Class A members can name a separate person or entity as the manager. And that's a manager managed LLC because there's an individually named manager. And that's what this illustrates. In this case, it's manager LLC that's going to be named by the Class A members. And this is how the org chart for that arrangement would look. Anything to add, Paul?
no, I don't think so. Yeah. And tying in back on the business acquisition side of things, this whole thing could just replace our words. AI probably can replace our words with real estate and business, and it all applies the same way. So
Great. All right, well, why don't you talk
AI,
about
take care
just
of
the
that AI.
general idea? Say it again.
You just say it out loud. I think AI will take care of it.
These are two common setups, whether it's traditional versus a no to low fee GP pumpkin pie. Unravel that one, Paul.
Yeah. So, like we mentioned a few times, every deal may be structured a little different. You really have to see how you're buying it as is and what your projected goal is, kind of the best case scenario, uh, 5 years down the road, 3 years down the road, and you move around what people are getting for their investment to see what makes the most sense, what would attract an investor based on your, good faith estimate on what this thing might be worth when you have your capital event being a refi or a sale or whatever. So there's two different ways. Many times, if there's the traditional syndication delicious pie, it looks to be half burnt, maybe a bad oven here. The left side got a little cooked worse so than the right. Where the LPs typically get a much bigger chunk of the pie, usually anywhere between 50 and 80%, sometimes 90%, depending on the area that you're buying it in. That's how, for many, many years, that was the most often the case. Recently, with these big value adds, people have been trying to keep more of the equity themselves, the active members. So in that case, there's really some fees up front, but you're not going to make much money on it until you hopefully hit that capital event. So the active members tend to hold on a little more equity in that deal. And that dotted line shows you that much of this is negotiable and just totally depends on the finances of the deal. So on the traditional side, usually more fees because it's generally an easier cash flow deal than the right side, where there's going to be pretty intensive value add to it, and there's really lower fees typically for the GPs on that side. So these two pretty gross looking pies just represent the various ways to cut it up for your own particular deal.
Great sales pitch. Solid.
Bad hats,
Yep.
gross pies. I mean,
Yeah,
what else could you need?
that's right. So then the next thing we want to talk real quick about is just the idea of the unit. So we touched on earlier is try to just come up with a plan that's as easy to just tell investors. Write a simple story. So you could make your units tiny fraction of a percent of ownership in the company, or you can make it round numbers that are easy to digest. So just an illustration of that, 4 units at 25K a piece is 1% each, or one for 4%, or do 1 unit for $250 and get zero point zero 0.01. And making things confusing, we do not recommend. Making investors do complicated math equations while they're thinking about whether to invest, we find is probably unnecessary. And most importantly, are you still awake? Wake up,
Are you
trying to
talking to
wake
me?
you up,
No,
Henry.
yeah, of course, of course. Yeah, of course. Of course I'm awake.
So just to recap where we've been, we talked about acquiring the Hot 100 unit deal. We talked about cutting up the pie, and now we're talking about marketing it through a 506B or 506C uh, exemption offering uh, allowed by Regulation D.
And it says
Real
it
quick.
says we're halfway there, but guys, we're further than halfway there. So
Oh yeah, absolutely. We're all downhill. It's
we're
all easy.
round in third.
Uh,
Yep.
It's
So
quick stumble. We're with a lot of words here, but 506B and C are short version is there's Regulation D allows companies to make private offerings to investors. Um, Securities are serious baseball. Regulators want to protect investors, and the stock exchange and public offerings all have a lot of red tape for good reason. They don't want investors getting ripped off, right?
yep,
Well, there are private offerings. They recognize, well, small businesses can't do all that sort of thing. So how can we exempt small businesses or small offerings from all that red tape where it allows, balances the interests of investors and the company raising money. So that's what a Regulation D offering is, a 506B or C. We'll talk about the distinction between those in a moment, but they exempt the company from raising money and going through all that sort of red tape is a quick way to understand it.
yep.
506B or C. Paul, why don't you talk about 506B and C?
Yeah, so when you're deciding who can I market to, whose money am I allowed to take under a certain exemption, you have to decide, do I want to raise from non-accredited investors? We'll talk in a couple slides from now what an accredited investor is. But do I want to ask maybe friends and family that don't qualify for an accredited investor? Um, or do I want to market it because I don't have any friends and family that are going to put any money in my deal? Do I need to, or do I want to raise for complete strangers? And there's a couple things to consider when you're deciding these two things. If you see on the left part of the screen, we have a hilarious joke there that Adam's come up with, and I'm going to let him struggle through that, not me.
506B or not 506B, which is verily, I tell you, 506C. That is the
Yep,
question.
that was just as bad as I thought it would be, and it was. Never failed.
So, what we're choosing, what we're talking about the exemptions. We try to frame it in the questions that really impact your decision on which one to choose. But like as Paul just started to describe, you can't have both. You can't have non-accredited investors and strangers in the deal. So what we mean by stranger in this case is a person you don't have a pre-existing relationship with prior to the offering. So you can't You can't be make contact with someone who you do not have a pre-existing relationship with. You cannot allow them to see the offering on a 506B. You're supposed to control this private offering. Again, it's private. It's called that for a reason. It's supposed to be confidential between company and people they have a pre-existing relationship with. So that's a 506B offering. And the 506B offering is unaccredited investors, less wealthy investors. The shortcoming is you can't publicly solicit, and these days it's a little tricky because we have the internet and people are talking to strangers or people that they don't have a significant relationship with all the time.
Yep.
But the important distinction there is you either get non-accredited investors involved or you get strangers and public solicitation involved. You can't have both.
Yeah, and we'll put an asterisk there. Not under these two exemptions. You can do crowdfunding, and you can make it from very, low income strangers, and you can do it that way. But that's not what we're talking here. These are the two most common exemptions used for real estate acquisition and business acquisition. So there are ways to do it. They're just not. They're just not probably going to be a good fit for your real estate or business closing.
Yep. So if you're going with the Regulation D, 506B, or C, just a reminder, 506B is the original private offering. It truly was private. We keep it controlled, only market it to people you have a pre-existing relationship with. And one way to help kind of remember this is that the 506B offering up to 35 accredited, non-accredited investors is the original private offering, and that's why it's called a private offering. 506C is actually a more recent development, 10 or 12 years ago, that allowed you to do a similar arrangement, but you were limited to accredited investors only. Even though you can talk to strangers and you can go get radio ads or any other advertisements to solicit investors, you're then limited on the backside from only taking from accredited investors. So just a little reminder that the original one is 506B, and that's the one that's supposed to remain private. Here's one other way to remember it, and I'll give you credit for this beautiful marketing material, Paul. What
Yeah,
does this mean?
yeah. So 506B, trying to remember, the difference between the two. Came up with Beavis and Butthead as folks that qualify under a 506B. So, and I think we're probably accurate to think that those two guys were unaccredited. Um, just now thinking of that. But 506B is for buds and blood, people you have a pre-existing relationship with. They can't be strangers. They can't have found out about you or learned about you from this particular deal. I saw that you put up there. That's pretty good.
You're welcome.
And 506C, you can advertise to the crowd, complete strangers. Great. You can go on the radio, you can go on billboards, get yourself on the billboard. Your mother will be so proud. However, you can't accept money from people unless they prove that they are, in fact, accredited investors. We'll talk about what those are in a second here, but these are two ways. Burn these two guys in your head, and you'll remember the difference.
Yeah, and when they were out in the 90s, they wouldn't have been accredited investors, but since
Now,
then,
a lot of licensing, a
turn
lot
on
of
turn on a
licensing.
lot of licensing, turn on the streaming YouTube, and the dudes, who knows, you
Yeah,
know?
the ballers, absolute
All
ballers.
right. So we talked about marketing it. Now we're going to talk about raising and closing and the documents that you should be putting together and talking to your lawyer about. Um, Real quickly, we don't want to bore everybody with it, and your lawyer needs to tell you about all this stuff. But just so you have some familiarity with it, first thing you're going to do is get a private placement memorandum. It's a long disclosure document with your business plan, with the risks involved in this investment, with your projections. Ultimately, this memo is a CYA to limit risk of fraud accusations from investors later on. So it gets investor and company on the same page at the time of the investment is kind of the short version of it. So it has a description of what the offering is, what it is that investors are getting for their offering. It has business plan objectives, sources, and uses, um, key personnel bios, any conflicts of interest that there might be, risk factors, those sort of things, and a projected profit loss. Um, so everybody's kind of on the same page, and so long as company follows that, then they're warning you, no, this is our plan, but it might not go as planned. And if it doesn't, investors can't come back and say, you never told me this, if it's right there in writing. That's the idea there. So then you're also going to want an operating agreement put together that reflects the PPM, and then the suitability questionnaire is one that where investor documents their sophistication level, experience. And if you're doing a 506C, it asks for the documentation to prove that the investor is indeed accredited and meets that definition. And then finally, subscription agreements, the contract between investor and offering company, so that they sign up and say, I've got the PPM and I'm buying a unit or 12.
That's
All
right. I'm
right.
going to close your whole deal because I like it so much. It is so screaming.
Yep.
Um, some of the other paperwork you're going to be paying for, you're going to be paying this attorney to do on your behalf. Operating agreement, that's how the company is going to run day to day, who has the authority to encumber the company with debt and other obligations. You're going to get a suitability questionnaire, which will have your investors telling you more so about their background, proving to you that they are, in fact, sophisticated enough to get into your deal. A lot of questions about, how much money they have, what do they do for a living, that sort of thing. And last is the subscription agreement, which is actually the contract to the new opportunity, the business acquisition or the commercial real estate deal. That's them saying, "Hey, I want to buy 3 units at $100,000 a piece of this new company that you're forming." And it's actually the enforceable contract between the investor and the company. So those are the three big important things that'll get put together about your deal. And here we are talking about how to qualify as an accredited investor. It's someone with a net worth of $1 million, excluding their primary residence. So if somebody lives on a very nice house and that's their biggest asset, that doesn't get them to qualify. Or they can do it income wise. They got to be making $200,000 a year or $300,000 a year as a couple or as an equivalent of a
Basel.
marriage. Yeah, spousal equivalent was the word I was looking for. And you must verify this for a 506C. You need to take the reasonable steps to do so. Now, if you're the quarterback of the deal, there are some things you could rely on, but there's obviously some risk on that. Someone could, make up tax returns and W-2s and brokerage statements, which it seems awfully silly. Kind of, that seems like a lawyer's precaution. Like, who would do that just to get into your deal? They're so desperate to get into your deal, they're making up uh, documents. It doesn't seem likely, but still, you could get in trouble if they're ultimately not qualified as an accredited investor. So we always tell people, go to a third party, go to verifyinvestor.com. There may be others, but that's the one we always tell people to go to. And that will show um, whether someone is accredited, and it'll kick out a little certificate for that. On the 506B side, you can rely on the investor checking a box saying that they are accredited. They don't need to prove anything to you. And I don't know if we talk about this in a future slide. A 506B, you can have an unlimited amount of accredited investors and only up to 35 uh, unaccredited investors. So there is a little risk on the checkbox. Let's say you're at 35 and someone still wants to get in, they just make up that they're accredited by checking the box. That's there's some concern there, and you're relying on that checkbox, but you should be okay. Like I said, go to verifyinvestor.com, have them prove it to you.
Yep. And then some of the paperwork gets filed. The notice filings, Form D is a requirement of the SEC when you're doing offerings. Basic info about the company and the type of exemption you're claiming. So 506B or C. There are also notices filed with the state. There's an online database called EFDNASAA. Uh, we won't go through that, but that's where you let where the states where investors reside. You have to give notice to those particular states and pay a fee based on the different states. That can vary from $0 to 700, and depending how many investors and how many states you have, could be a couple $100 or a couple thousand. So those are the notices that get filed. Have your lawyer do that on your company's behalf. And I think that's about all for us,
Who are
Paul.
these tired
Thanks.
guys? Yeah, no, yeah, appreciate folks tuning in. If like we mentioned earlier, find a lawyer that does this for a living and that you're comfortable doing it with. That by no means does it mean we are the only guys in the country that do this. There are literally probably hundreds, and a few probably dozen within 50 miles of where you live. But it's important to do. It's important to have somebody kind of be able to walk you through on your particular deal how you could set it up. Because if you've never done it before, it does get kind of confusing. So.
Yeah,
Uh,
and I want to talk real quickly about some common things people might think if they've not been through the rodeo before. When you reach out to a lawyer, it's good to have a lawyer anytime. So anytime you can meet somebody that and have them around. But if you don't have a lawyer and you're sending out LOIs, it's important to be ready to reach out to one or start making contacts with people you know or other people who are doing what you're doing because what you really want to have the lawyer involved on a PPM when you are getting your PSA together, at least at the time when you get it signed, because then you have what your 30 days or 60 days already counting down, and closing might be anywhere from 60 to 90 days away, and you need to be keeping the lawyer in the loop because they do have to draft these documents after you nail down all the data. So there's a little bit of a dance, but you should get them involved. Turnaround, just is dependent. Could be a week or two, or it could be a month or two. So be sure you're getting them the information. Um, and some other common questions we have are what, Paul? You got anything else you want to add? I thought
nope,
of
that sounds like, cost, of course, get that out of the way early. They're very wide ranging in costs. So, I think those are it. Pretty common sense stuff whenever you're using a service provider. How long is it going to take and how much do it cost? But
Yep,
it's important to get, if you have a deal in LOI, that's the stage that you should start making your calls to lawyers and giving them, find somebody you're comfortable with, ask them how much it's going to cost because you do need to know, how much money you need to come up with to get this thing rolling. So,
yep. All
all
right,
right,
great. Well, thanks for
this is a
joining
good
us, folks. Appreciate it.
good spot to stop. If anybody has any questions, feel free, but we're going to stop the recording. Thanks a lot.